The market loves a good panic, and that's exactly what's happening with Oxford Lane Capital right now. Investors are running for the exits, but if you look past the noise, you'll see a high-yield cash machine that's still doing what it does best: printing money. This is one of those rare moments when sentiment hands you an opportunity, and the only question is, are you ready to take it? The market is a moody beast. One day it's rational and efficient, the next it's throwing a tantrum over the latest economic headline. Sentiment is everything. When the market decides it doesn't like a stock, it doesn't just walk away, it torches the place on the way out. So what's an investor to do? Simple: buy the dip when the fundamentals haven't changed. Today we're looking at one such opportunity that's been unfairly beaten down. Let's dive in. Buying the sentiment, dip Oxford Lane Capital, ticker symbol OXLC. OXLC is a closed-end fund, or CEF, yielding a jaw-dropping 23.2%. OXLC invests in collateralized loan obligations, also known as CLO equity, which is a leveraged bet on corporate credit. The market freaked out in March over recession fears, sending OXLC's price lower. But fundamentally, nothing changed. Understanding CLOs without falling asleep. Close by pools of bank loans, package them up and distribute payments in a waterfall structure. Senior debt holders get paid first, then junior debt, and finally CLO equity holders, who take the biggest risk but also get the biggest potential payout. The key risk? Corporate defaults. If too many companies default, CLO equity holders eat the losses. But the market tends to overreact to credit risk, pricing in worst-case scenarios before they materialize. Why the market is overreacting? OXLC holds leveraged loans, and we've seen their prices dip recently. You can track this through the Invesco Senior Loan ETF, BKLN. The usual suspects, recession fears, tariffs, and risk aversion, are driving the sell-off. But here's the thing. Corporate credit is stronger than people think. Post-COVID, companies shored up balance sheets and the Fed's rate hikes discouraged reckless borrowing. Defaults remain low. The 12-month default rate is below 1%, and while it will rise, history suggests it won't be catastrophic. CLOs are actively managed. When a loan repays at par, CLOs can reinvest at discounts, effectively building par and offsetting losses. The bottom line? The market is pricing OXLC as if we're heading into a debt apocalypse. We're not. Yes, OXLC carries credit risk. There's no sugarcoating that. If defaults spike, OXLC will take a hit. But investing in debt isn't about avoiding defaults entirely. It's about earning a high enough yield to compensate for the risk. Right now, OXLC is well-positioned, low corporate leverage. Unlike some CEFs, OXLC isn't overloaded with debt. Growing earnings power. Around 17% of its portfolio hasn't made its first payments yet, meaning cash flow will rise. A strong cushion. It has room to absorb higher defaults before its dividend is at risk. Will OXLC's total return match its nearly 25% yield? Maybe, maybe not. But what's clear is that the market has overshot its fears, creating a buying opportunity. Oxford Lane Capital is one of those misunderstood stocks that investors write off too quickly. The yield is high, the structure is complex, and most people don't take the time to understand it. But history tells us that ignoring high-yield opportunities out of fear is a mistake. Volatility can be your worst enemy, or your best friend. When the market throws a fit, it hands you a chance to lock in strong income streams at a discount. And right now, Oxford Lane Capital is one of the best income opportunities out there. Buy the fear, collect the cash. Don't let fear stop you from building real wealth. If you're serious about earning passive income and maximizing your portfolio, now is the time to act. Hit that subscribe button, drop a comment with your thoughts, and let's grow our dividends together.